Good evening and welcome to tonight's webinar. My name is Brian and we're going to be reviewing a little bit of everything, but we'll be focusing on moving averages and the moving average crossover. Again, please ask questions through the question function. You can type them in, and it's very important that you do that because I can answer those questions and sometimes they lead to some other topics. So please go ahead and use that question function as we go throughout. Sometimes I'll pause and I'll check to make sure that I answer those questions. I'll try and get to all of them. Let's go ahead and just move into this first slide, which I think most of you know because you've been with me before, and that is going to be this disclaimer, which is very, very important for all of you, no matter how long you've been trading. All right, tonight's outline, we're going to be doing a quick catch-up of the fundamental analysis, a very quick catch-up. Not much has changed since I talked to you a few weeks ago. We'll go into technical analysis, and I'll kind of merge the technical analysis with moving averages that you see there, because again, moving averages basically would be considered technical analysis. And then we'll do a quick review and show you what's next coming up as far as the webinar 2 weeks from now. And all of the webinars I've done are recorded, and last month's was very, very popular as far as talking about trading psychology, so make sure you review that, and I'll show you the link where you can get that at the end of tonight's webinar. So fundamental analysis and the quick catch-up, again, not much has changed. So basically what's going on is that the European Central Bank and the world central banks, whether they're coordinated or doing it separately, they are making sure that there's accommodative policy, for the most part lower interest rates or low interest rates, and that's supporting stock market growth. It's definitely supporting the U.S. stock market growth, and other regional stock markets have followed suit. What does that mean for traders? As the stock market goes up and up and up, that sometimes can mean lower volatility, lower trading ranges. So still good trading opportunities, but we might have to wait a little bit longer for them. We might have to trade our size, our contract size, a little bit differently, as the length of the trade may change a little bit. So you just have to be aware of what the current market cycle does for you as an individual trader and where you're at. You know that I'm very big on segmenting education and segmenting information for individual traders. So when I say that what it means for you as an individual trader, hopefully you understand that, and if not, that's where the webinar from last month, from 2 weeks ago, will come in very, very handy. How to get this news? forexfactory.com. You can link there right from your IBFX website. You can also turn on the TV. Here in the United States, we have CNBC, and there's kind of you also have Bloomberg. That's also a very global news source, Bloomberg TV and Bloomberg.com. Again, as I mentioned, links from your broker, so your broker is providing that good information, whether it's through webinars like this, whether it's through links to other sites, or maybe it's through other types of commentary. Raggy Horner, which a lot of you are familiar with, she always talks about that in her webinars and her daily commentary. And then, of course, you can go out to other market sites as well. I'm sure some of you have other sites in your toolbox, so make sure that you're using them and focusing the information to you as an individual trader. So again, just kind of wrapping up the fundamentals. I don't want to spend too much time on it because it hasn't changed much, but overall, equity markets are very, very strong with the intermarket relationships that we'll talk about. For the most part, that's meant a weaker dollar as the equity markets have rallied. And again, just a little bit quieter intraday movement. The stock market might move 10 points or 15 points or 20 points and then up 80 points, and then the next day 10 points, and then after that down 20 points, up 10 points, and then another 80 points up. We're trending up in the stock market and trending down in the United States dollar against various pairs, and that's just a function of better U.S. economic data from around the world, and again, central banks from around the world making sure that they're providing that accommodative support. So a friendly environment for equity prices. All right, it's key that you guys understand that until something fundamentally changes or until something technically changes, it seems that the equity markets are going to try and run. We are at a crucial level in the stock market, and I'll bring that right up here. We are at 135 here in SPY, and if I bring that out to a one-year chart, you can see last summer's highs, 135, 135, 135, 135, 135. Right here we're at 135. We were there on Thursday. We went down off of it on Friday. We're back up there today. We'll see what tomorrow brings, but the markets are trying to pump through. It's kind of a tug of war where this resistance line is. We use trend, we use support, we use resistance. Those are major technical terms that you should be aware of and be able to use in your trading toolbox. Well, right now we're at major resistance in the stock market, and we're going to see if we're going to push through or if we're going to bounce off it and go the other way. So we are at a fun technical level there, and that should whether you're invested in the markets, whether you're trading in the markets, you should be aware of that, as those intermarket relationships are very, very important. All right, so that's our fundamental view and kind of our segue into the technical picture. So let's go to the next slide there. And what are traders doing with the fundamental news? Well, we know in foreign currency, the US dollar has been weakening for the most part. We know that in equity markets, the equities have been strengthening. So we talked about trends, which way the markets are trending. We covered that. Support and resistance, I just brought that up. We are at a resistance level in the stock market. We're not so much at resistance levels or support levels in the Forex markets, and we'll get into that, and I'll be able to show that to you. So like I said, I'm going to combine technical analysis, this slide, in these intermarket relationships with the next slide, moving averages. What are they? When are they designed to be used? And then bringing in a variation of the moving average and bringing in the crossover and how we use that in various time frames depending on if you're a long-term trader or a shorter-term trader, and then managing that indicator using fundamental and technical analysis. So moving averages, they basically, just in their name, moving average, an average of those prices. I'm not going to get too much in the definition because that's something that you can Google if you really want to know what makes up the moving average. But the most important line here, when are they designed to be used? It is a fact that moving averages are used more often in trending markets. They work better for us in trending markets. You can do variations of them. All of these indicators can have their own variations, and that's what I'll talk about in a couple weeks as we go into a study called moving average convergence divergence, otherwise known as MACD. But for the most part, moving averages are typically used in trending markets, and you're going to see that when we get into the IBFX platform. So let's start looking at the moving average, and then we'll bring in that crossover. And again, I had that slide, what are they? And I'm just going to give that to you as a homework assignment. If you don't understand what a moving average is, the definition of it, how it's computed, that's something so easy for you guys to do. You could do that at investopedia.com. You can Google it. You can buy a book on it. You can Google moving averages, whatever it may be. You'll find out that definition. It's not as important as when are they designed to be used, okay? That's the most important part of any indicator out there. You should know when they're supposed to be used. And if I go right into here to Interbank FX and I bring up the platform here, the MetaTrader 4 platform, if I go to Insert and I go to Indicator, okay, Insert Indicator, and I look very quickly for my trend because I understand that moving average is a trend. Under trend, it brings up some popular trend indicators, and right here, moving average. It won't be found in oscillator in sideways markets, okay, where MACD, which I'm doing in a couple weeks, will work, but I'm actually going to use the MACD in trending markets in a couple weeks. I'm going to use a variation. But when I look under trend, I find moving average very quickly. Then I can click on moving average, and now I can put in my parameters, how many periods I want it to be, and I'll talk about that in just a moment. Do I want it to be simple, exponential, smooth, weighted? Again, traders pick different things, but overall, they're pretty similar in scope. The most popular ones are simple and exponential. Again, I'm not going to get too much into these different definitions because you guys can Google that and learn that on your own. This is basically something that I want you to see as live in the markets and applying the moving average and specifically the moving average crossover. All right, and I've already drawn a few on here. So again, to do that, I go to Insert, I go to my indicators, I go to my trending indicators, and then I go to my moving average, and it brings up this box that I can pump in, and then I press OK, and it plots it. So for the longer-term traders, let's look at the longer-term trend. And the longer-term trend, I'm going to focus on, there's two trends here, all right? So this is a daily chart going back all the way almost a year ago, just about a year ago, where every single bar on here going from right to left is one day, one trading day. And as you saw here, when I can input the information for my moving average, it says number of periods. Well, period is each one of these. These are periods. So if I'm looking at a daily chart, my periods are going to be based on how many days we're looking at. If I'm looking at a minute chart, minute by minute by minute, and so intraday charts, then obviously it's going to be a 5-minute bar, 10-minute bar, 15-minute bar, and it's the number of those bars. So what these two lines represent, the red line that you can see is following the price a little bit more closely, that is a 50-period moving average. It takes 50 periods into account, the most recent 50 periods. Then I have the blue line, which you can see is a lot more smoothed out. Why is it smoothed out? Because it's taking more data into account. It's taking 200 periods of data into account. So I have a 50 period crossing over a 200 period. And when we have two moving averages that we draw, we always look to see when the one that has smaller amount of periods, the moving average 50, as you can see right here, when it crosses over the 200 period, which is the blue line right here. So you can see that in September of 2011, 4 or 5 months ago, the red line crossed down over the blue line. What does that mean? That means two things. It could mean an exit for people who are long, and it can be an entry for people who want to get short. So the entry would be, if the 50 crosses down over the 200, most people will use that as a system to get short whatever pair they're looking at. They would short, in this case, the euro versus the United States dollar. If you remember what was happening last summer, a lot of things were going on with the euro region, and nothing has really changed, although they're trying to fix things in Greece and Italy and wherever it may be, but we still have problems over there and austerity measures, whatever you want to call it. So fundamentally, things changed last summer in Europe when we were pretty volatile in the stock market and other markets. And for the most part, you can see that the euro has trended down against the United States dollar. Only recently has it caught a nice bid and started to come up. But if you shorted it at the 50 over the 200 period moving average, because that was your system and that's how you used it, we always put in stops based on our account size, based on our risk tolerance, based on how long we expect to be in the trade. So obviously, this daily time frame and this 50 period, 200 period moving average crossover is a longer time frame trade. So this might be someone for a larger account. You might be risking 200 or 300 or 400 pips in this scenario to make 500 pips, 800 pips, 1,000 pips. So the idea is when this crosses over, the price, let's see where the price was. The price was right here, let's say at, and I've got to move, I'm sorry, I'm just going to move this webinar toolbox over here so I can see. So it crossed when the price was, let's just say, roughly 36.20 or so. So 36 basically, 36.50, 1.3650. And the idea is you don't get out of the trade until the 50 period moving average moves above and over the 200 period moving average. So that's what I mean. You might be having to risk 200, 300, 400 pips to make 500, 600, 700 pips in this scenario. So you get in at 36.50 roughly, and it went against you almost about maybe 500, 600 pips. So you might have been stopped out on this, again, depending on who you are as a trader and what you were trying to get done. And it had that pop. The 50 and the 200, the moving average, you can see they've never crossed. And then eventually it started to turn down. So this move right here was kind of a violent move, and it might have gotten people out. But if they use the indicator, they're still in it. And if they got in here at 36 even, well, it went down as low as into the low 30s and even into the 29 handle and even lower. So it went down towards 25, 26, 27. And now, as you can see, the equity markets are going up, and that intermarket relationship, the equity markets are on fire. The euro has been on fire compared to the US dollar. The euro went 25, 26, 27, 28, 29, 30, 31, 32, 33 basically. It's gained back 8 pennies, but that's lower than where your entry was. And if the equity markets keep climbing and this relationship keeps climbing, this is going to rally, 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 and the moving average will eventually cross. So it works when there's a trend in place. And I'm going to show you that when it doesn't work, when there's a trend in place. So again, most of you may not be long-term traders, but I just want to show you that it doesn't matter how long you're in a trading time frame. As long as you adapt the moving average periods, then you can trade any time frame as long as you understand how to use the indicator. I'm going to show you a shorter time frame just so you can see. And someone just put in the MA is a lagging indicator as a question. Absolutely, the MA is a lagging indicator. In my webinars, I always talk about price action, trend, support, resistance. If you understand trend, you trade in the direction of the trend. If you understand support and resistance, you can buy at support and hopefully have a higher probability trade, but again, nothing is guaranteed, so we put stops and targets in, and you can sell short at resistance. So look at this move percentage-wise, okay? The move right here went from 1.4550 to 1.31. That's a big, big, big move. And these didn't cross over, this trend right here down, these didn't cross over until it was way down here. So that's exactly right, is you could say, I'm getting on a mature move, and I need to be careful because my risk reward may be a little bit skewed. If I think there's resistance, I might be getting in near the top of the move. So right here, you could say, if I can draw my line right across, roughly, okay, not guaranteed, but roughly, there's resistance right there around 45.30. Over and over and over is resistance, and then boom, we take off. Well, it goes 45.30, and then we go all the way down into the hot mid-30s. We go almost 10 pennies, and finally you're getting that entry. So you're exactly right. If you can understand fundamentals and technical analysis and price action, that's how you kind of manipulate these indicators a bit. So I'm not saying you just go out there and turn on a system. I'm saying if you use the moving average crossover system, you go ahead and you adapt it to what the markets are doing, to time frames, trends, support, resistance, things like that. So that's a very good question. That's why I want you guys to ask questions. That question, MA as a lagging indicator, not only is the answer yes, but now you can see that we go further into it, and you can see, wow, how far it lagged this move down. And again, fundamentally, back last August, that might have been when things in Europe were going haywire, and you might have said, I'm getting on this, and then maybe I can use the indicator as a confirmation that I'm right. And let's face it, if you got 10 pennies out of a move, maybe you're greedy and you stay in it, or maybe you say, oh my God, I just made 10 pennies on a good trade. I risked this to make this. Fundamentally, they were telling me to get short the euro, and you know what? I'm going to get out or take some off the table, and then I can use my indicator maybe to manage the rest of it. Maybe you did stay in this longer term using this indicator. Look also how the 200 period moving average act as what? It acted as resistance. So this move up might have been scary depending on where you got in, but this was comforting to see it acting as resistance here. So very, very, very good question. And yes, you're right. The moving average is a lagging indicator. So you have to be aware of that you're not probably going to get in at the beginning of the move. You're going to get in as the move is happening. Let me still show you why it's so important to understand when a moving average is used. So that was a longer term trader, longer term time frame, big moves. What I did now is look at the time frame. We're looking at 15 minutes. So every bar is 15 minutes. And you can write this down. The blue line is the longer one. It's a little bit more smooth. It's hard to tell here. It's a 9-period moving average. The red line is a 5-period moving average. The red line is the one that's the crossing one because it's the 5-period moving average crossing over and under the 9. So let's just look at 1 day of action, just 1 day. Okay, and it's a little bit hard to see, so we're just going to take our time here. So today we opened up. This is the 13th of February, all right? We opened up, and we may have had, overall, overnight, we got some news. Greece, things went well, stuff like that. So we were hoping that maybe everything would carry over. The stock market, our stock market futures were up. World stock market futures were up, and the euro got a nice pop early on. It was closed down here, and it popped up to here, so a nice move. So the first trade here is the red, which is the 5-period moving average, crossing down. So that is a short entry. And all of a sudden, nothing really happened. We went sideways, and the red crossed up. And that was two things. It exits you out of your short trade, and it enters you into a long trade, okay? So now you're not, you were short, you basically scratched the trade, now you're flat, and boom, you go long. You go long, and now what do we have? We have a trend up, up, and the red line finally crosses right here. So you got in maybe here at 57.65, and you got out here at 57.86. Okay, not a bad trade. It trended up. Okay, 57.65 to 57.88, 20 pips. Then it crossed over and it said get out of your long and get short if you'd like to. Fundamentally, you can say, no, I don't want to get short based on grease, whatever it may be. Again, fundamentally, you get to decide how to adapt these. But if you're just using the pure system, you get out of your long with a nice gain and you get short, and the markets kind of go sideways and you get out of your short very, very quickly. And it looks like right here, you probably scratch the trade and you get long again, and we trend up. And you have another winner because you exit right here. You exit out of your long, you get short, it's down and up. You basically scratched your trade because it didn't trend. It kind of went sideways. It went a little bit down. It went a little bit up. So as it's going here, you're getting short, long, long, short, short, long, long, short, and eventually it starts to trend down later in the day today, and you get a nice short entry, and you ride that down, and you know what? Look to see from right here at 2:15 GMT time, okay, right around 8 o'clock in the morning, my time, when this U.S. stock market starts opening, all of a sudden the euro just went down, 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 and the next time that the red crossed over the blue is right, it hasn't happened. That's the point of a trend. You never know when it's going to start to trend, so you use the indicator kind of as a system, but again, you can use it more long, more short, depending on the fundamentals, depending on your technical bias, whatever it may be. You get to adapt it. Maybe you trade a little bit bigger on this trade, on this long side. Maybe you trade a little bit shorter, smaller on the short side because you are more bullish, whatever it may be. But when a trend is in place, it can be very powerful. You entered short here at 58 even, 57.99, 58 even. And now the pair has gone down, 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 and it's at 57 even, and you're still in that trade. Pretty nice trade using this indicator. So you had small losers, maybe a small winner, small losers, maybe a small winner going long, scratch, 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 and then one nice long trade as we trended down for whatever reason. The stock market almost finished on its highs today, and that intermarket relationship that I talked about went away a little bit. They beat up the pound all afternoon here today, in morning and afternoon in the American session. So they beat it up going into basically the next day of trading as we're starting to enter the Asian session right about now. So we'll see if this carries through or not. We'll see what the stock market futures and things like that do. So that's how you do it. It doesn't matter what time frame. You just have to make sure you're looking at the right amount of periods, and you have to understand that in sideways choppy action, the moving average isn't going to work as well, but you can see that you don't have big losers with it either for the most part. It's only if you're wrong and going against the trend that you would have a big loser. If you were long here and you held on, obviously that could be a damaging trade to your account. So the system, nothing is guaranteed out there, and anything can happen at any time. Greece can make an announcement in the next 30 seconds for all we know. The point is you've got to have that money management in place for your account size, trading the appropriate trading size as far as contracts go, and making sure that you have stops and targets in place for the most part, and that you're managing the trade from beginning to end. And that's right here, managing the indicator using your fundamental and technical analysis. It's not good enough to just go ahead and turn it on. You have to have some management capabilities, understanding what's going on out there. Let's see, I'm just going to check back for questions. MA is a lagging indicator. Change the color from blue to green for a better view. Yeah, I can go ahead and change that, and I'll show you guys how to do that in just a moment. It's impossible to see the blue. Okay, so let's go ahead and do it. Let's change that color. I was noticing the same thing. So what I can do is I can go to my indicators. I'm just going to go ahead and delete the blue one. So I right click on it, I go to my objects list, and it doesn't look like it wants to pop up here. Let's see if I can get it on let's see if I can put it on here on the one that you can actually see. So I go to my indicators list, and I have my moving average. Okay, so that's the red one, that's the 50. And if I go to this one, it's going to be the blue one, and it's navy, not blue. And we're going to change it to green. I'm going to try and find a lighter green color for you. The lime green usually works pretty well. It's the same color as my candles. So lime green, so hopefully that looks a little bit better. Let me go ahead and bring you over back to the pound here on the shorter term one. So I just right click, I go to my indicators list because I have Fibonacci's drawn as well. So a Fibonacci that I drew would be an objects list. And if I right-click and I go to my indicators list, I go to the bottom one and I edit it. And navy, we were going to change that to lime green. Press OK. All right, so hopefully you guys can see that a little better. Again, it's a small time frame, so it's taking in data, so it's hard to see. I can move it down to a 5-minute chart, and you'll be able to see similar information. So again, look at the markets kind of going sideways here. So you're getting a lot of these crosses. We kind of call this whipsaw. It's not meant to work here, but you don't know when it's going to start to trend, so you could start to use it. You just might be having a bias one way or the other. And like I said, let's see, you got short here, and again, this is a different time frame. You exit out of your short, you got long, you got short here, and long, short, like I said, and then here you go, you get short, and right here they kind of bump up against each other, they bump up against each other, they bump up, and then it takes its dive. So again, that's where you kind of have to vary it to your time frame and what periods you're looking at. So for the most part, the less time frame you're looking at, the smaller amount of time frame, a 5-minute chart, 50-minute chart, you're looking at smaller amount of periods of data, okay? If you're looking at a daily chart like this one and you're looking for the bigger move, you're taking in more periods of data. Again, you can fine tune these, so I just use the 50 period and the 200 on the longer term, and I use the 5 period and the 9 period on the shorter term. Hopefully you guys can see that better, but thank you very much for pointing that out. Let me see if I have another question. Okay. What is the best moving average? Close, open, high, or what? I didn't go into that too much. I don't get too far into those. I kind of keep it simple, stupid, and I don't try and finagle these too much. You're not going to see much of a difference, especially think about it. Looking at these periods of data, if I chose to edit it, and let's see if I can go to my indicators list, and I go here, and I edit it, whether it's simple or exponential, if I move them both to the high, and I press OK, and I move this one, and I edit it, and I move this to the high, and I press OK, you're not really going to be noticing too much of difference. It's going to move a very, very small amount. So don't get too caught up in that. You need to get caught up in understanding what is a moving average, how is it used, what type of market's trending or oscillating, and how do I apply it with my knowledge fundamentally and technically with what's going on right now. There's not going to be much of a difference for that question that you asked, okay? But that's what I said is there are some different types of inputs that you could put, but it's not moving it that far. You could use simple or exponential, smooth, linear, weighted. Don't get caught up in that. It's not going to move too much. Most people use simple or exponential. The difference between simple and exponential weights the most recent data more, the most recent bars or periods more. Simple smooths that out a little bit, and then as you can see, you can do the open, high, lower, close. And if you read a book on moving averages, you would get all of these different types of ways to use it, but I don't think that there's a need to get caught up in it. It's more of understanding I can add this to my toolbox and I can use it, but I still have to be savvy about the markets. I still have to put stops in place because a Greek announcement coming out in 30 seconds doesn't care about your moving average, right? A Federal Reserve announcement doesn't care about your moving average. So when do you have it on? When do you not? If Ben Bernanke is speaking in the next 5 minutes and it gave you a cross, you may choose to use it. You may choose not to use it at all because something is bigger is out there. You may choose to dial back your trading size. That's the kind of stuff that I want you paying attention to, is how to manage it given what's going on in the markets, okay? Hopefully that makes sense, that yes, even though the moving average crossover is quote-unquote a system, you are the bigger system, and that's what I talked about in the webinar 2 weeks ago. You're the bigger system out there that has to manage things, okay? And you have to dial things in to match you as an individual trader. So very, very good question because it leads to other things. Let's see. I found that the 5 and 10 MA on the 30-minute screen gives me a good signal, especially if I use a 20-pip buffer before taking the trade. Fantastic. So this person has used moving averages to their liking, obviously, and they found an appropriate amount of risk for that time frame. So that's exactly it. Someone who's trading on a daily time frame and using a 50-200 crossover is going to have a much different amount of pips that they're risking than someone who's using 5 or 10 or 15 minutes and they're using the 5-9 crossover. That's exactly it. You've got to dial it in for you. If you're not a day trader, then you don't care about the 5 or 10 or 15-minute light, maybe. Okay, it all depends on you. Between the period, I don't know if I understand this one. 15-minute, does the size or gap between the periods of any significant? I don't know if I totally understand it. I'm not sure if I totally understand the question. Then there's another one. 32.41 was the last sell signal, still good. So you must be talking about the euro, about where the last cross basically was. I don't know what time frame you're on and what you're looking at, and again, what moving averages you have. It'll be very different than what I've drawn here. But yes, the point is you guys seem to be very familiar with it. All that I ask that you do is adapt the periods for you, adapt the actual strategy and the crossover in the quote-unquote system for you as that individual trader. How much time are you in the trade? How many pips should you be risking for that time frame? You're exactly right. And the other thing is, remember, think about the markets. Are the markets volatile right now, or are they not volatile? Right now, today, let's look at today in the euro. The trading range today in the euro, we had a high of about 32.80 and a low of about 31.60, so about 120 pips or so. Look at the size of the bars here on a daily chart, and look at the size of the bars now, okay? These bars here, and look at the size of the bars back here. These are much, 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 much bigger bars, so you might have to change the amount of pips that you're risking. That person who said, I risk 20 pips and I use this and this, well, it might change as the markets change. This 20 pips may not have worked. You might have had to do a smaller amount of contracts and maybe risk 30 or 40 or 50 pips because it's a more volatile market. How do I know that it's a more volatile market besides, or less volatile market, besides looking at the average trading range? I'm going to type in VIX, and I've gone over this many, many times in my daily commentary, many, many times in previous webinars. The VIX has been going down, 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 down as the stock market goes up, 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 up. What the VIX is telling us is saying, hey, the stock market's going up. There's no fear out there. Greece isn't a problem. Europe's not a problem as a whole. Whatever it is out there, not a problem because the volatility is going down. This is the volatility last summer in the 40s. And you could see the average trading range for the Forex bars on a daily period were much larger. Now, VIX is down at 15, 16, 17, 18, 19, 20, and obviously the bars, the intraday trading ranges are a lot smaller. So what we've been having lately in the stock market, again, if I go back to the stock market, is over the past few months or so, we've been trending up, 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 up. Look at this move from let's just say December, January, and half of February, we've gone from 120 to 135. That's $15, okay, of a $120 stock. That is 12%. 12% in 2 months. Good return or bad return. In an unleveraged product like the stock market, where you don't have options or foreign currencies, you're just looking at the actual stock itself, 12% is incredible, all right? So over the past couple months, we've had a very, very big run. Look at what the pound has done over the past, in that same time frame, just over the past 2 months. Okay? Here it is. Here is December sideways, and then obviously in January we just took off and went up and up and up and up, and now we're starting just to correct a little bit. But so if you understood that relationship, the stock market's going ballistic, everything is starting to work in as far as the economy chugging along in the United States, which a lot of people focus on as far as traders around the world and other economies follow us. And then you saw that the accommodative policy going on and they're fixing things over in Europe. Well, this relationship might help you to say on a maybe a little bit of a longer term time frame, depending on who you are, you have a bias to the upside because obviously the trend is your friend. Well, you can clearly see the trend has been up week after week after week after week until finally we've come on up here a little bit higher. So finally, we've run into some resistance for whatever reason, but overall, that trend has been in place big time up there, and the trend has been in place for the equities as well. So that's what I mean by fine-tuning it, given your knowledge out there. So good questions, guys. Very good. Let's see. Looks like there's one more. Between the 9 and the 5. Yeah, I guess you're asking between the two different ones. I mean, I just picked arbitrarily the 50 and the 200, which are very well known. The 5 and the 9 are very well known. If any of you know Fibonacci numbers, sometimes people like to use the moving averages that are Fibonacci numbers, like a 5 and an 8, a 21, that kind of stuff. So, no, I mean, again, you just have to understand that you can't use a 50 and a 200 for the most part if you're a short-term trader. You can't use the 5 and 9 if you're a longer-term trader. So you've got to focus it. And again, there's kind of some rules of thumb out there that any good moving average site or book would have some information on. But 5 and 9 is pretty popular for a short-term intraday trader, which I think most of you are. So how do you stay on top of what's going on in the markets, inter-markets going on? Well, let me go ahead and we'll review, and then I'll show you those links. We reviewed the fundamental events, the macro and micro events out there. Again, everything seems to be getting better in the United States economy for now. Everything seems to be getting better in Europe for now. Technical analysis, we saw some major trends in place. We were able to see some support and resistance, and definitely resistance as of right now in the stock market. We'll see what that does to equity prices. We'll see what that does to that intermarket relationship. Intermarket relationships providing trading edges to our Forex pairs that are trading with the United States dollar. And then we took a good look at how to use moving averages, where they're best used, trending markets versus range-bound markets, and then how to apply a crossover where we have two different time frames, the shorter time frame crossing up or down as our entry as it crosses over that longer, smoothed moving average. So again, next webinar, I'll talk about MACDs, moving average convergence divergence. Right now, I kind of timed this. The markets are trending, so that's why I went with the trending indicator moving averages. And then in another 2 weeks, we'll see if we've gotten overbought in the equity markets, if we're oversold in the United States dollar, and we start to get some divergences. So that's what the MACD is. I'm going to show you how to use moving averages and tweak them to look at divergences to see if a trend is stopping. So that if you're in a trade with a trend and you're using your moving averages, you might be a little bit wary because you could be worried about the trend starting to change a little bit. So this next webinar in 2 weeks follows right on the heels of this. I think they'll complement each other nicely. We'll do the regular fundamental analysis update. We'll do our technical analysis where we'll merge that with the MACD, the emphasis there in 2 weeks. Education recordings, like I said, if you're unsure who you are as a trader and time frame, all of the webinars I've done for IBFX are recorded, okay? And that's right down here, the YouTube site for Interbank FX videos. And 2 weeks ago, I did one on trading psychology. It's a very, very strong one. I urge you to use it if you haven't seen it. And then I've done a lot of other webinars on various topics and market catch-ups and things like that. So this is the education site where it gets you out to various links from Interbank FX. I write almost daily in their dailyforextradingedge.com under their market trend analysis column. So look at Daily Forex Trading Edge for regular posts. I just duplicate them at my own blog here, but you can get everything right there at your dailyforextradingedge.com page. And then at the very bottom, I do also post intraday market commentary through the IBFX Connect site. And if you want to follow me, you can follow me at the Locals Take as I just give some commentary. I'm not there for people to follow my trades because I might be hedging something and doing a longer term type trade. Hedging, I mean, those intermarket relationships are very powerful, and Forex might provide a hedge to an equity portfolio, 401ks and IRAs, a lot of things that people in the United States have. So I'm not there for people to follow me as far as do the trades because it may not make any sense to what you're looking at. I'm there for you to follow me as far as the commentary that I post. So keep that in mind. It's the commentary that you're following. All right. You've got to think for yourself out there. You've got to be your own trader. So make sure you're learning and making sure you understand who you are. So there's your tools, and I look forward to seeing you in a couple weeks on the webinar and in between now and then on the Daily Forex Trading Edge and obviously intraday at the IBFX Connect site at Locals Take. So again, things can change very quickly. We talked about volatility. We're not as volatile as we were last summer. The daily trading range is a little bit smaller. There's still good opportunities. You might just have to tweak your trading size and your trading frequency a bit. But things can change very, very quickly, and we could be in a volatile series of markets tomorrow. So remember, trading plans, reasons for entry based on the charts, using chart patterns, price patterns, using technical indicators such as the moving average, reasons to get out for a loss, okay, based on the charts because your chart pattern was violated, your moving average crossover was violated, whatever it is, or if someone's about to speak and you just say, gut feeling, I don't want to be in the markets right now during this announcement or the speaker, and reasons for an exit for a profit based on the charts. So 3 things. Why did you get in based on the charts? Where are you going to get out for a loss based on the charts? Where are you going to get out for a profit based on the charts? And manage it from beginning to end using the charts and using your analysis. Very, very, very important because the markets may start to shift and change down the road, and you want to be prepared to make money in any market. So let me just check back to see if there's any final questions here. Are the YouTube YouTube videos different from those on the IBFX site? There's lots of different ones. I provide specific ones every 2 weeks, these ones specifically, and they get recorded there for some people who couldn't make it or people who want to watch it. So you'd be looking for my name basically there, and there's about 15 or 16 or 17 that have been created over the last 8 months or so, as long as I've had a relationship with Interbank FX. So you can find them there. If you have any questions, you guys, I'll put up my email right at the very beginning, so you're welcome to email me if you have any questions, but you should be able to find everything right there from the Interbank FX YouTube site. So again, thank you very much. Happy trading, and I'll look forward to speaking with you definitely in 2 weeks.